Hey, what's going on, everybody? It's Ryan here. Okay, so the new 2021 guidelines or rules were just released as far as how much you're allowed to contribute to various retirement accounts, such as IRAs and 401ks and that sort of thing for the year 2021. And then also they've outlined what the new phase out ranges are as well. So I figured I would go ahead and record this quick video. I was just taking a look at it here myself. You're going to see that some of the things are already highlighted as I'm going through it. So with that, let me go ahead and share my screen and we'll walk through it here together. I will tell you, not much has changed between 2020 and 2021, but nevertheless, let's go ahead and go through it here. And actually, let's go down here to the bottom first. This is real easy. First off, none of the contribution limits have changed at all. They're exactly the same in 2021 as they were in 2020. And this is the way it works if you're not familiar with it. So for 401ks, 403bs, most 457 plans, and the federal government Thrift Savings Plan, the TSP, all remain unchanged at $19,500. The catch-up contribution limit for employees age 50 and over is an extra $6,500. So if you're 50 or over, you can actually contribute $26,000. That's the maximum. And if you have access to a simple retirement account at work, the maximum that you can contribute to those is $13,500. And the limit on annual contributions to an IRA is still $6,000. Now, if you're 50 or over, you can do an extra $1,000 catch-up contribution. So your maximum is going to be $7,000. So real simple, contribution rates are exactly the same. The thing that has changed, and you'll see that here at the top, is that the income ranges have changed. And by the way, this is straight from the IRS website. And you know what I'll do is I'll go ahead and include a link down below in the notes section so that you can go there as well if you like. By the way, if you really want to get more in depth, you can click right here and it'll link you to a PDF on their site where you can get even more detailed information on all of this. But this just what we're looking at right here that was released on October 26, 2020, gives you really probably most of everything you're going to need to know on this. But let's go through the changes that did take place as far as specifically as far as the phase outs and such. So let me go ahead and read this and then I'll kind of stop and I'll explain what different things mean and certainly offer my opinion here on a couple of things. But the income ranges for determining eligibility to make deductible contributions to traditional individual retirement accounts, to contribute to Roth IRAs, and to claim the Savers Credit all increased for 2021. Taxpayers can deduct contributions to a traditional IRA if they meet certain conditions. If during the year, either the taxpayer or his or her spouse was covered by a retirement plan at work, the deduction may be reduced. By the way, a retirement plan at work just means, let's say you have access to a 401k plan. So if you have access to a retirement plan at work, either you or your spouse, the deduction may be reduced or phased out until it's eliminated, depending on filing status and income. Now, if neither the taxpayer nor his or her spouse is covered by a retirement plan at work, the phase outs of the deduction do not apply. So here are the phase out ranges for 2021. So here's what this means. So for instance, let me go and read the first bullet point, then I'll explain. So for single taxpayers covered by a workplace retirement plan, the phase out range is $66,000 to $76,000, which is up from $65,000 to $75,000. So what that means is, let's say you're single, income is under $66,000, you could contribute to a 401k, let's say at your work, on a pre-tax basis, and you can also contribute to a traditional IRA and get a tax deduction. Now, having said that, I will say in a lot of situations, I find that it's best for somebody in that situation at that income and such to contribute to a Roth IRA. Now, not always going to be the case, may not be the case, certainly for you, I don't know you, but a lot of times being able to get tax-free money in the future, a lot of times that can make a lot of sense. keep in mind, when you contribute to any of these pre-tax accounts, it's nice getting the tax deduction now, but eventually you're going to have to pay the taxes on it. And, you know, we never know for sure how much of that is going to go to us and how much of that is going to be shared with Uncle Sam. It depends upon what the tax rates are at that time, what your income is, and all that sort of thing. So if you end up doing a really good job of putting a lot of money into 401ks, you know, contributing a lot, and if they grow well, the investments do well and such, you're going to have a lot of money in these retirement accounts that have the money's never been taxed. And ultimately that can push up your income in retirement, make your Social Security benefits taxable when they may not have been. It'll make Medicare cost more to you than it might have otherwise, all those sort of things. So so a lot of times I will recommend a Roth IRA. Tax-free money is good. Yeah, you don't get the tax deduction up front, but you have to weigh what you're going to save in taxes today versus what you may have to pay in taxes down the road. So, and quite frankly, a lot of times it can make sense to have a balance between taxable, you know, tax and tax-free as far as the withdrawals that you're going to take in retirement. But that's a whole nother video right there. So for married couples, filing jointly with a spouse making the IRA contribution is covered by a workplace retirement plan. The phase out range is 105,000 to 125,000, which is up from 104,000 to 124,000. So again, hasn't really changed very much there at all. Now, for an IRA contributor who is not covered by a workplace retirement plan and is married to someone who is covered, the deduction is phased out if the couple's income is between 198,000 and 208,000, up from 196,000 and 206,000. So again, slight increases. Now, I explained what that meant for the single person as far as, you know, their income was under 66. As an example, they cannot or they can contribute and get a tax deduction. The way that it works is if their income was over 76,000, they cannot contribute to an IRA and get a tax deduction, assuming again also that they have that access to a workplace retirement plan. And then the range right here between 66 and 76. So let's just say we're talking to somebody that's, you know, they're, I don't know, 48 years old and they can contribute $6,000 to an IRA. Well, if their income is, let's say, halfway in between there, let me make my math easy. In between 66 and 76 is 71,000. So that means they're halfway through the phase out there. So what that means is that they would only be able to contribute half as much to the IRA and get that tax deduction, or they can only contribute up to 3,000 to get a tax deduction. Any more that they contribute, they would not get a tax deduction on for the IRA contribution. So that's how the phase out works. And it works the same again for a married couple as well. No matter whether you have access to the retirement account at your work yourself or whether your spouse does. It's just the income ranges are different, as you can see right here. So let me go ahead and just highlight that. So you've got 105 to 125. And then if it's your spouse, so 105 to 125 is if it's yours, if you have access to retirement plan at work. And then if your spouse has access to it, it's 198 to 208,000. And then for a married individual filing a separate return who is covered by a workplace retirement plan, the phase out range is not subject to an annual cost of living adjustment and remains $0 to $10,000. The income phase out range for taxpayers making contributions to a Roth IRA is $125,000 to $140,000 for singles and heads of household, up from $124,000 to $139,000. So as long as you make less than $125,000 and you're single, you can contribute the full amount to a Roth IRA. And then again, same thing. If you make more than 140,000 and you're single, you cannot contribute to a Roth IRA. If it's between 125 and 140, you can contribute, but not the full amount. Again, it phases out depending upon how close your income is to that $140,000 mark. For married couples filing jointly, the income phase out range is 198,000 to 208,000, which is up from 196,000 to 206,000. The phase out range for a married individual filing a separate return who makes contribution to a Roth IRA is not subject to an annual cost of living adjustment and remains $0 to $10,000. And then finally, the income limit for the Savers Credit, also known as the Retirement Savings Contribution Credit, for low and moderate income workers is 66,000. For married couples filing jointly, which is up from 65,000, 49,500 for heads of household, which is up from 48,750, and 33,000 for singles and married individuals filing separately, up from 32,500. Okay. All right. So hope all that makes sense. If you have any questions on it, just let me know. Take care. Have a good one. Talk to you soon.